Assalamu alaikum wa rahmatullahi wa barakatuh. We'll be starting in 5 minutes, inshallah, and maybe earlier. So stay tuned, please. We'll be starting the session very soon. Can we start?
Brother, shall we start now or wait a little bit?
Let's start. In the meantime, people are joining. Inshallah, the time we start, in earnest, they can have most of the people, inshallah.
Okay. Distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh, wa salatu wa salam ala nabiyyina Muhammad wa ala alihi wa sahbihi ajma'in. It gives us a tremendous pleasure today to welcome you to this public hearing session on the exposure draft of AYUFI Financial Accounting Standard on Participatory Ventures. This event is held in collaboration with the Bahrain Association of Banks and UAE Banks Federation. We would like to thank them for taking the efforts and extending their support in organizing today's public hearing. The public hearing is one of multiple steps in standard development process at AUFI and represent an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts from all corners of the industry on the newly issued exposure drafts. The exposure draft of AUFI FAS on participatory ventures prescribe the principles of accounting and financial reporting for the participatory ventures. Now, and without further ado, let me invite to the virtual floor the Director of Professional Standards Development at AUFI, Mr. Mohammed Majd Bakir, who will present the exposure draft and will walk you through its main content while answering time to time your questions in an interactive session. Brother Majd, the floor is yours.
Thank you, Sister Haura. There is a comment. The Madiha says that there is no voice. Can we check? Or Madiha, you need to do the adjustment at your end. Make sure that the sound volume is at the right position. Can you please, before we start? Bismillah ar-Rahman ar-Rahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Sayyidina Muhammadin wa ala alihi wa sahbihi ajma'in. I'm sharing now the presentation. We will be walking through this presentation, inshallah. Is it visible to everybody before we start? I shared my screen. Hawra, is it visible to you? I can't hear you.
Yeah, we can hear.
Okay, is it visible?
Yes.
Okay.
Yes.
This public hearing, as my colleague Hawra mentioned, constituted part of the consultation process we conduct with the industry, and it is now, to my best knowledge, this is the second leg of a series of public hearings that we hold for newly issued exposure drafts. The second in English, and I assume that we will have up to 4 public hearings for this particular exposure draft. One would be in Arabic next week, for a total of 4 public hearings, inshallah. So earlier in the year, we held 1 public hearing for this exposure draft, and this would be the second. As we used to say all the time, that we need to go through the exposure draft for 2 main purposes. The first is to do or make any proposed changes to the text of the exposure draft in terms of certain conceptual matters and certain suggestions as you may find proper. And second, in terms of any writing styles issues, editing whatsoever. So we are open to both scenarios. If for your feedback on that, that would be our pleasure to collect your views and comments, and we will make sure that these comments, inshallah, will be taken to the working group, respective working group on the standard, and later on to the accounting board, AUFI accounting board, for final approval and for issuance of the final standards, inshallah, this year. This is, a standard phrase we put at the beginning of every standard. AUFI Financial Accounting Standard number, Participatory Ventures, is set out in paragraphs from 1 to 76. All the paragraphs have equal authority, and the standard should be read in the context of its objective and financial and the conceptual framework for financial reporting as endorsed by AUFI. All AUFI financial accounting standards shall be read in conjunction with the definitions, Sharia principles and rules, and key considerations provided by AUFI Sharia standards in respect of such products and matters. This standard, in particular, shall be read in line with Sharia Standard 12, Sharika or Musharaka and modern corporations, and Sharia Standard 13 on Mudaraba. Preface. So now we are going through the components of the standard one by one. Preface, PR1, Mudaraba and Musharaka are perceived to be the most common forms of Sharia compliant participatory or profit or loss sharing or taking structures. As PR2, as the Islamic finance industry has grown in terms of size, products, and structures, and forms of Musharaka and Mudaraba, there was a need to review existing standards, namely Fast 3 Mudaraba financing and Fast 4 Musharaka financing, and to align the same standards with the new conceptual framework and Fast 1 general presentation disclosures in the financial statements. And this standard, as all of you know that this is considered the building block for our standard development process, in addition to the framework, which defines the broader policy that the board undertakes for development of these standards. This forms part of the comprehensive project undertaken by IOFI Accounting Board for review and revision of financial accounting standards issued earlier, particularly those standards that need. It was decided that they need, a revisit and at times a full, a review or revision, depending on the, industry feedback and depending on the interaction with multiple stakeholders for that purpose. PR3, furthermore, the previously issued standards did not address counterparty accounting for these structures. So the board, we will come into that in the rationale for sure. So the board, in its comprehensive project, evaluated the need for these revisit and whether to go through a limited revision or a full, review. And then it decided that both Fast 3 and Fast 4 need, a full revision, as we call it. And then the new standard, it was decided to put all these two, different types of treatments for different products under one standard, as was decided by the respective working group and the board. PR4, this standard brings accounting and financial reporting for participatory ventures in line with global best practices, particularly in relation to joint ventures. Participatory ventures particularly have unique characteristics and are distinguished from conventional joint ventures in terms of structures, classification, and reporting requirements. Once issued, this standard will supersede the existing Fast 3 Mudaraba financing and Fast 4 Musharaka financing, as we will, present later on. Introduction. Any questions so far? Any comment? Any suggestion? Any proposal on the text or on the drafting of the exposure draft? Anybody who wants to drop a comment or share a comment, please do that through the comment box. We have a chat box. Please do that, and if needed, we will also open the floor for those stakeholders who want to address us live, address the audience, and provide their comments. Overview, IN1. This standard prescribes accounting and financial reporting principles for recognition, measurement, presentation, and disclosures to apply in relation to participatory ventures, including most of the common structures and products based on Mudaraba and Musharaka. IN2, these standards shall be applied in respect of accounting and financial reporting by the investor or investors, depending on the case, the working partner or partners, as well as the participatory ventures with regard to all such participatory ventures that fall within the scope of this standard, including those with fixed and variable equity or quasi-equity shares. So these three areas are the key, areas that are covered by the standard and which, as we mentioned, distinguish, this new standard from old standards that have been there for a couple of decades. We move on. Rationale for issuing this standard, as we will see here, IN3, in line with the new strategy of the board, IOFI initiated the review and revision project, as we mentioned, in 2018 to review and revise all existing phases that needed such a review. And as part of the process and in view of the feedback received from market participants, it was decided, considered imperative to perform a comprehensive revision of the existing IOFI phases on Mudaraba and Musharaka, in addition to the proposed provision or revision, of Fast 27 investment accounts, because both, these standards involve a bit of, commonalities, particularly the use of participatory structures. Any questions so far? We continue the rationale for issuing this standard. A revision of in IN4, a revision of these standards was considered pertinent because the same had been issued quite a long time back. And since then, there have been significant developments in the structure and applications of the products based on musharaka and mudaraba, as well as in the financial reporting standards applied to similar transactional structures across the industry globally. Furthermore, as a result of the finalization and issuance of AYUF comprehensive, the conceptual framework for financial reporting and FAS 1, it was inevitable to ensure that all the earlier issued FASs are also aligned with the new pronouncements, particularly certain accounting treatments prescribed by the earlier FASs were not considered aligned with the revised IOFI framework and the generally accepted accounting principles wherever, there is, compliance with Sharia, and hence their alignment with the same was considered by the board very much, necessary. Significant changes from previous standards. The new standard, accounting and financial reporting for participatory ventures, introduces significant improvements to its predecessor standards, namely FAS 3 and FAS 4, inter alia in the following aspects. The existing standards did not cover the cases of participatory ventures in the books of account of the working partners and the participatory venture itself. So this is, one of the key new additions that now IOFI accounting standards cover both sides of the balance sheet, and in certain situations the venture itself, the project itself that involves both sides together. B, the existing standards were not aligned with the new conceptual framework and generally accepted accounting principles in many aspects, including issues like establishment of control, quasi-equity accounting, and off-balance sheet accounting. All these aspects were introduced into the newly reviewed pronouncements, particularly the framework and FAS 1, and the board felt it was quite necessary to realign the issued standard, the standard in issue at the time with these new pronouncements. Any questions so far? Any suggestion? Any comment on the text, on the drafting? Please, the team, if you can take their anybody's comment. We continue the significant changes from previous standards. C, the specific cases of participatory venture with gradual transfer of ownership or transfer of units, such as variable equity ventures, particularly running musharaka, diminishing musharaka, and restricted mudaraba, were not covered under the existing previously issued standards. And D, the existing standards, as similar to other certain earlier FASs issued by AYOFI, included certain Sharia-related requirements in the body text. As a practice, it used to be compiled at the end of every standard in the form of basis of conclusions, but those basis of conclusions related mainly to Sharia permissibilities and impermissibilities and issues that fall within the domain of Sharia, as well as in certain respective appendices in line with other newer AYOFI FASs. Such requirements have been removed, and the standard refers to and shall be read in conjunction with respective AYOFI Sharia standards, as is now the common practice, the starting point for the development of our standards. As we mentioned at the beginning, we start with the framework, FAS 1, and the respective Sharia standards. Those are the underpinnings of the development or review process to go with. Any questions so far? This is for the rationale. Now, objective of the standard. In short,
Brother, there is one question in the chat.
Yes, please, if you can read it out.
Yes, from Mr. Deep. Which stakeholders are responsible of updating of significant changes to our Islamic finance governing bodies?
Actually, this, the matter of who's responsible is, varies actually from jurisdiction to jurisdiction. As at the level of IOFI, we update the standards, we issue the standards, and we share with the industry. In countries where adoption is mandatory, for sure, the central banks, the regulatory authorities will make sure that once these standards are issued, will be taken into the market, and in certain situations, these standards are subject to effective dates. In specific situations, IOFI encourages earlier adoption. So this can happen at different levels. We are flexible for this kind of new adoption, but at the same time, it is up to the regulatory bodies also to decide such matters, and at the time they have to start adopting these standards, and in certain situations it is left for the institution itself in case of where IOFI encourages early adoption. Institutions, to my best knowledge, particularly in countries where adoption is mandatory, even before the effective date comes into full swing, the certain financial institutions decide to adopt these standards because they feel these standards are in their best interest in terms of accounting for the proper financial reporting, accounting for certain products, which particularly in the case where such treatments and such requirements have not been covered in the past. This is my answer to your question. Any other question? Do you have any other
No more
questions?
question.
We proceed. Okay. So in short, the objective of this standard is to prescribe the principles of accounting and financial reporting for participatory ventures. Again, participatory ventures is a broad term that can be established on, as identified by the board, on two main modes of investing. Now we call them investing on the balance sheet, on the asset side of the balance sheet. The old standard used to call the same financing. Now it is that the board changed its strategy and its approach, and now we specifically focus on the main objective of the product itself, whether it is financing or investing. In this particular situation, mudaraba and musharaka, when on the asset side of the balance sheet, they are considered investing. We move on. Scope of the standard. This is again, this is a uniform structure of the standard. We are following the same the same sequence of components of the standard. Scope. Now, scope, this standard shall apply to all participatory ventures as defined in paragraph 4D, except for the exclusions, those areas scoped out, provided in paragraph 3, in respect of accounting and financial reporting by the investor or investors. Wherever we put S in brackets, it means that we may have the situation of one investor, multiple working partners, or multiple investors, multiple working partners, or multiple investors, single working partner, and so far. So that's the purpose. If you've come across these S's in brackets, it means that we are covering these two different various scenarios in these standards, as well as the participatory venture itself. The standard shall not apply to the following. This is the scoping out paragraph. This is very important for every adopter of the standards to see where the standard fits, and where a stakeholder can apply the standard and where it cannot. A, investment accounts and similar participatory instruments issued by Islamic banks and similar financial institutions, which are subject to the requirements of relevant IOFI phases. So for investment accounts, it's a different structure, different setup. So these are not covered here. Other similar participatory instruments, particularly participatory instruments that constitute a specific kind of relationship between the issuer bank and the holders of the certificates, this is not within the scope of this standard. B, investment agency, al-wakala bil-istismar, which is subject to requirements of respective IOFI FAS, which is FAS 31 on wakala. C, co-owned assets based on شركة الملك. As such assets do not constitute participatory ventures because by definition participatory ventures depends on the intentions of the party and the approach the party take to willingly establish a venture. But in the case of Shirkat Al Mulk, this intention is not there because the formation of the partnership or the venture, so to speak, comes through different mechanisms, which is joint ownership of certain assets, as in the case of inheritance, for example. So these are scoped out of this standard. D, participants investment funds and other similar participatory instruments issued by TACAF institutions to the TACAF participants, which are subject to requirements of TACAF standards. This is again, out of the scope of this standard because treatments for such products are, specific and takes into account the accounting requirements for that particular arrangement, which is takaful, which is, it requires a unique set of, requirements, accounting requirements. So we refer to the respective standards in such situations. Any questions so far? Even, our valued participants can take permission from the team to speak up, to provide their comments live. We also welcome this kind of, live interaction. Then investment accounts of investment structures in the form of a legal entity. For example, those including issuance of share capital by the working partners. This is out of scope. Investment in sukuk, shares, and other similar instruments which are subject to accounting in line with the requirements of the relevant AOFI FASs, except for sukuk based on participatory ventures to the extent of underlying product or asset, accounting as referred back to this standard. Then investment funds, entities having the status of a legal entity which are subject to financial reporting in line with requirements of the respective AOFI FAS. And then we have investments in corporate entities having parent, subsidiary, associate, or joint venture relationships, or investment through trusts, which shall be accounted for in line with the requirements of relevant FAS. This is for, the scope and scope out. Is there any questions so far before we move to definitions?
Yes, brother, there are 3 questions. First question is from Mr. Deek. Thank you for your answer. Also, who is responsible of updating our embassies in host country?
Actually, it's not. We don't have anything to do with embassies. Actually, we treat directly with central banks or regulators in your respective countries. So those in those countries that adopt our standards on a mandatory basis, once the standards are issued, we share these standards, the soft copy version of the standard immediately. Before we actually print the physical version of the standards, we share the soft version, I'm sorry, in a PDF format, and this is for their convenience, where the regulatory bodies can at their level reshare with the industry in their jurisdiction. And as I mentioned earlier, they can, depending on the effective date of the standard, they can, in most of the situations, the regulatory bodies also follow the same measures followed by AOFI, that we either we leave it for the effective date to become, in effect, or for the individual institutions to start early adoptions in certain cases. But we don't have anything to do with these diplomatic missions in countries where, and here in Bahrain or in other, parts of the world. This is out of question, because our work focuses mainly on the banking and finance and other, areas relevant areas in our work. So we deal directly with regulatory bodies and with financial institutions, but not with diplomatic missions. Is there any
Thank you, brother. There is another question from Mr. Uwais. What is the reason for exclusion of banks?
We didn't exclude banks. Did we exclude banks? I didn't say that. We excluded certain structures. For example, investment accounts for banks on the liability side. Yes, this is excluded, but we don't mean that we are excluding banks. We are excluding certain structures, within the business model of the banks, because those structures are subject to different, requirements, and they are not fall here. Technically, they don't fall within the scope of this standard. Any other question?
Thank you, brother. There is another question from Mr. Sayyid Imtiaz Abbas. Why is participatory venture definition not included in the chapter of definitions?
Actually, it is there. We will provide this. We will come into that participatory venture. It is because we have the structure. We are defining the structure. It is well defined in control of assets and business. This is the broader structure, and within this structure, we will come into participatory ventures. Yeah. Any other question?
No more question.
Okay. So in terms of the definitions, we will, try to take your questions one by one over time, inshallah. But let's now finish certain sections within the standard or in one go. Control, it is defined in now it's a standard control of the determination of control of assets and business. It is defined there. And also it is defined in FAS 1 and framework. But for practical reasons, it was decided that we take the concept of control in one central standard and we cover it, at length to account for the different cases and different scenarios. Mudaraba, as is defined in IOFI conceptual framework. Most of the basic definitions you'll come across this in the conceptual framework and in certain situations in FAS 1 also. Musharaka, in the specific context of this standard, is a partnership musharaka based on shirkatul aqd, whereby two or more parties agree to combine their assets, labor, entrepreneurship, financial commitments, and or goodwill for the purpose of making profit. So as you can see, the concept of musharaka is mainly derived from the Sharia concept of musharaka, but here we also, in certain cases, we provide our own definition to cover the main aspects that would be tackled by certain standards. So all in all, these definitions are also in line with Sharia, but with different flavor, because here we are talking about accounting and certain aspects within the process of accounting. So we need to come up with our own definitions to be clearer on certain aspects of these modes and contracts. Participatory venture, as I mentioned, is also defined in the standard on control. Determination of control of asset and business. Sharia compliant participative venture. This is what our brother meant. This is the board decided to add Sharia compliant participative venture to the term as a term, but not to the name of the standard. Here, just to be much clearer about that, Sharia compliant participative ventures, SCPV, it is defined as a business venture formed or constituted on the basis of a Sharia compliant participatory structure. So the structure, as I mentioned earlier, it is the a broader sphere. Within that, you have the ventures being a virtual entity, but not a legal entity, as we mentioned in the scope and the rationale, including musharaka and mudaraba or any similar structure creating a Sharia compliant partnership, irrespective of the name or nomenclature. So why we are talking about virtual entity, not legal entity? Because once we have a legal entity, it is out of scope, because This takes us to a different level, like an entity established through a license to carry out or conduct these kind of products or transactions. Here, the standard covers that aspect that relates to the work of institutions, where institutions established within the structure of the institution, virtual entities to handle these kind of transactions. Is the definition clear for our brothers and sisters? Sharia compliant participative venture. This is just in a nutshell. We try here to give the notion of the term from an accounting perspective, and also taking into account the requirements of Sharia. Variable equity participatory ventures is a type of participative venture in which the respective amount of quasi-equity contributed by investors, as well as a working partner, remains variable through ongoing drawdowns and redemptions by the working partner on a very frequent basis, normally subject to a maximum limit of such quasi-equity contributed by the investors. Here, the standard explains the most common form of variable equity participative ventures is running musharaka. As many of you are aware, running musharaka is now a product practiced or offered in certain jurisdictions, which also, is operated under Sharia principles and rules, and the decisions or fatwas, issued by Sharia supervisory boards in certain countries. Although certain other musharaka-based and mudaraba-based products and instruments may also classify as such. This is for the variable equity participatory venture, which has other subcategories that are also covered within the scope of this standard. Any questions, or we proceed? Working partner is a partner.
No questions.
No questions. Okay. Is a partner in a participative venture principally entitled to manage and or operate such participatory venture, and who receives equity contributions from the investor or investors. The working partner at times may also commingle its own equity in the participative venture. Explanation. A working partner, depending on the nature of the underlying contract, may generally include a mudarib or a musharaka as working partner. So the working partner is a broad term that covers, in the case of musharaka, the working partner; in the case of mudaraba, the mudarib, because the mudarib assumes the role of working partner, because by mandate the mudarib must be enabled to play a working partner role as to the mudaraba transaction, because of a mudarib, as we know in Sharia terms, mudarib must be empowered to handle certain tasks without any restrictions from the Rabbul Mal. So in this situation, mudarib himself becomes very much similar to the working partner feature. Any questions, or we move on? So now we are done with the basic components of the standard. Every standard we have the same components. Now we move on to the body of the standard, where the standard provide the accounting and the financial reporting requirements for the certain scenarios. As we come into that, inshallah, we have here under this standard many scenarios where are determined or defined by the relationship between the respective parties involved in the transaction or in the process. So assessment of extent of control by investors and the working partner, because this is the starting point to determine the relationship between the two counterparties, and based on that, the rights and obligations of every party to the transaction will also be defined, and accounting will ensue depending on the nature of the relationship between these different counterparties. Now, controlled by the investor or the working partner, accounting and financial reporting approach suitable for a participative venture shall be assessed by determining the extent of control by the investor and the working partner on the participatory venture, as I mentioned. The extent of control over a venture and the assets underlying the venture, where applicable, shall be assessed in line with the definition of control as we referred to in the respective FAS standard, which has been issued under FAS under the number of FAS 46. Assessment of extent of control by the investor. We continue the same paragraph 7. An assessment of the extent of control in line with the requirements of paragraph 5 above shall result in one of the following conclusions. So we have these different, conclusions that depend on the proper assessment of the element of control. A, participative venture is controlled by the investor or investors. This is one. We will cover that in their respective places within the standard. B, the participative venture is controlled by the working partner or partners. Also, we have a certain section for that. And then C, the participative venture is under shared control of the investors and the working partners, and in which case accounting treatment will be tackled under, or in its respective section within the standards. We have these three different scenarios. Every scenario, as I mentioned, will dictate the accounting treatment that will follow. Summary of accounting approaches applicable to investor and the working partner. So here the table, this is part of the standard. The table is part of the standard in the body of the standard. The following table summarizes accounting approaches applicable to the investor and the working partner in different situations related to the control of participative ventures, in line with the requirements of the paragraphs to come, from 9 to 31. So if the controlling party is the investor or investors who control the participative venture, so we refer to paragraphs from 9A to 31A. The accounting treatment in this particular situation will be either pass-through accounting approach, or in certain situations, a net investment participatory venture accounting approach, if pass-through approach is impracticable, as we will come into that, and we will also come into the concepts of these different approaches and the different, relationships that are entailed for every or within every approach or accounting treatment. For now, we start with the accounting treatment by the investor. On the other side, because the standard, as we mentioned, the standard covers both sides of every transaction. So on the other side, the counterparty also has its own accounting treatment, in which situation is the off-balance sheet accounting approach. Okay, because when control is established for the investor, what we expect in this situation, that for the counterparty, because of lack of control, it will come under the off-balance sheet accounting approach, which goes without saying because of the lack of control for the counterparty. So for every scenario, as you will see, there is proper justification why we are having these different kinds of treatments on both sides, because of the practicality of the situation where, or the relationship between the two parts, and which entails different treatments to do with. Here in B, the controlling, if it is decided that the controlling party is the working partner, controlling the participative venture, we mean all the time that control over the participative venture. Again, we are referring to 9B to 13B. Accounting treatment will be also here, this third option will be net investment in participatory venture accounting approach. On the opposite side, the counterparty side, it will be quasi-equity accounting approach. C, investors and working partner have shared control over the participatory venture. In the books of the investor, it's net investment in participatory venture accounting approach. And the same for the counterparty, also net investment. So as you can see, the different scenarios entail different treatments, but all these treatments are logical in terms of the practicality, in terms of application. And under every scenario, we will come into the proper full set of accounting treatment, as I mentioned earlier, starting from initial recognition, measurement, and disclosure, etc. Any questions so far? Any question? Just think of the table as a summary of the different scenarios where we will be covering under this standard. If the controlling party is a perpetual participatory venture, accounting treatment on the investor side would follow the net investment participatory venture accounting approach, and on the counterparty side, accounting as equity, while following quasi-equity accounting approach as far as practicable. In scenario E, participatory ventures involving gradual transfer of ownership, which was earlier defined, the situations where we have this kind of setup, gradual transfer of ownership through units, through the increasing, decreasing shares of the respective parties. In the books of the investor, the net investment in participatory venture accounting approach, if pass-through is impracticable, we'll come into that. And on the counterparty side, the quasi-equity accounting approach. Any questions so far? For all these scenarios, we will, inshallah, we will have each covered in its own respective place within the standard. In F, variable equity participatory venture, we are referring here to paragraph 59, as you'll see, and for the accounting in the books of the investor, the preferred method to be followed here is net investment in participatory venture accounting approach, and for the counterparty on the other side, the preferred approach would be quasi-equity accounting approach. This is a summary of the different scenarios, different situations. Now we will dig deeper into that. We will see that in detail, and we will follow the accounting treatment that I mentioned, accounting and financial reporting in the books of account of the investor. Now, if the investor has control, as we mentioned, an investor shall apply either of the following approaches for accounting and financial reporting of its investment interest in a participatory venture. In case of participatory venture is controlled by the investor, only the pass-through accounting approach as prescribed in 10 to 20, unless considered impracticable. What do we mean by impracticable in these cases? Impracticability may arise from different elements, including the cost-effective, aspect of the practice. In certain situations, if we apply certain approaches that might not be much cost-effective and may not justify the cost associated with financial reporting for that particular situation. So depending on, as you know, accounting, focuses on an approach or the notion of significance. If any transaction or any amount or any product or any item in the balance sheet that have significant impact on the reporting, or as part of the reporting, it would be part of the financial reporting. Otherwise, for these insignificant items, as in certain situations we follow the principle of clubbing, reporting under one line item, etc. So depending on significance of items, this is in line with the basic accounting actually, So this can be a determining factor for which approach the investor will follow, particularly if pass-through is not that much feasible. So the standard also give way to other treatments. In all other cases, including the case where the participative venture is controlled by either the working partner or is under shared control of the investors and the working partner, the net investment in participatory venture accounting approach as prescribed in paragraphs 21 to 30 shall be followed. So as you can see, this is accounting logic where there is shared control, whereas control is not in the hands of one party. The net investment where each respective party only reports its net interest or net investments in the participatory ventures with the aggregate of all these investment and net investments in the participatory venture, making the full value of the participatory venture if we are looking at aggregates. But individually, every investor or every counterparty has to show that respectively in their own accounts based on the net investment or net interest for each. Any questions so far? No questions? Okay, we continue. We are starting with the pass-through accounting approach, initial recognition. On initial recognition using...
There is one question from Mr. Deeq. Does this investor accounting apply to grant funding, microfinancing, and any other small amounts for business activities and employee lifestyles and rewards for employees for loyalty?
No, actually, this is out of scope, as I mentioned here, because we have a different line of business. We are talking about ventures that are established based on willingness of the parties to come up with a joint venture whereby they can make commercial profits, and where can they share their respective risks, put their respective resources into this economic process that are mainly intended to make profits for all the parties involved. And this is again for, as I mentioned, for institutions that have these kind of most of investing on their asset side of the balance sheet, and by that we are here, targeting the institutions at the level of the institutions and their counterparties. If the counterparty is coming from a commercial background, but the standard fits all the cases of that willingly established ventures which aim to make profit and based on risk sharing and resource sharing. And so the intent here of the parties is clear cut. As you can see, it is profit making. That's why it's called a venture. So a venture differs from other structures that you mentioned because of the element of profit and the risk sharing approach. Is that okay? Any other question?
No questions.
So for the pass-through approach, the investor shall recognize the assets always as liabilities, any corresponding liabilities to these assets, if any, that underlie the participative venture in its book of account, applying the initial recognition principles as applicable in line with the relevant FAS. Proportionate assets and liabilities shall be recognized applying the same principles in cases where the arrangement has more than one investor. So this is in short, this is the pass-through accounting approach for recognition of the assets and any corresponding liabilities in the books of accounts of the partners. Any question on this method or approach? Subsequent to initial recognition, the underlying assets or liabilities shall be measured according to requirements of relevant IOFI phases. Proportionate accounting shall also apply where applicable. The standard explains that this shall be recognized on a gross basis by the investor. That is, assets to be included in assets and liabilities in liabilities, if any. Here we have to show the full picture of the venture, not the net basis where only respective interests are reported. This is the gross basis in short. Gross basis, shows all the aggregate amounts without any deductions, because here we are talking about the level of the venture itself. An investor shall determine, subsequent management also continued, an investor shall determine at each period and impairment of the value of the investment and their pass-through approach. This is also a common practice that we take impairment into account over time. At the time of subsequent measurement, we have to consider this scenario that assets may experience impairment in value. And then this should be in line with the respective IOFI phase, in which situation is phase 30, as you are aware. The settlement risk, as well as existence of onerous commitments, such as guarantee or sale undertaking, shall also be considered for impairment purposes. So impairment takes into account this full set of factors in the situation of subsequent measurement. For revenues, so we start with the recognized amount, the amount of the investment, then any revenues and expenses related to that also. Unless contrary to a specific requirement of the standard, the resulting revenues and expenses, gains or losses arising from the participatory venture shall be measured and accounted for respectively according to the nature of the contracts, in line with the requirements of relevant IOFI phases applicable to such transactions. Normal accounting policies of the investor shall apply in respect of such matters. Revenues, expenses, gains or losses shall be recognized on a gross basis again. The same shall be included in respective line items in the financial statements of the investor. Working partners. Now, if we are talking about reporting in the books of the investor, what about the working partner's share of profit? The working partner's share of profit payable according to the contractual arrangements shall be recognized as an expense at the end of each financial reporting period in the books of the investor, based on the best estimate of amounts payable as at the respective period end, based on contractual and constructive obligations. Same paragraph, working partner's share of profit continued. Any contingent or conditional variable share of profit payable to the working partner as per contractual terms shall be recognized as an expense based on best estimates of the same, applying the following principles. Variable share of profit related to past performance based on contractual arrangement shall be recognized as a liability when it becomes due on an accrual basis. This is in line with Sharia. Variable share of profit related to past performance, which is contingently reversible on a cumulative basis, for example, reversible in case of a future loss, or is contingently dependent on a decision by a third party or of a third party, such as the case where a decision of a trustee at maturity of the transaction would be needed, shall be recognized as a liability when due, irrespective of probability of their reversal. Again, this is, to reflect the Sharia, Sharia principles and rules in relation to recognition of liabilities. These are among the most critical, components of accounting reporting for this kind of transactions, where Sharia permissibilities and impermissibilities are embedded in the accounting treatment. This is a very good example where Sharia comes, hand in hand with accounting treatment and is reflected properly on the accounting treatment. And then again, as I mentioned earlier, the starting point for all our accounting standards come from Sharia standards in the cases where we have certain standards, covered on the Sharia side. For Mudaraba and Musharaka, yes, as I mentioned earlier, we have these standards. We continue the working partner's share of profit, reversal liability, earlier recorded in line with the B above. For example, in the case to recovery loss or against below par performance shall be recognized as a reduction of the respective expense. This is accounting logic, in line with in which such reversals occur, in line with in the period in which such reversals occur. Also, that here we are applying different principles, all of which are consistent. We are applying the matching principle. We are applying the proper right and obligations of every stakeholder or every counterparty to the transaction in line with Sharia. So as you can see, in every para, almost you have all these elements at play together to reflect the reality of this or speciality of this financial accounting standards that are developed by AOFI, which are very much unique and very much distinguished in terms of their ability to account for the nature of the transactions, for the certain elements in the transactions that relate to financial reporting and accounting, and for the many aspects like the risk reward profile, the profit distribution, the business model of the transaction. So as you can see, all these elements will be at play time to time, and you can come across that in all AOFI standards that now have been newly issued or are under revision, particularly participatory ventures that we are covering today. Do we have any questions so far?
There is one question from Dr. Munir. Proportionate is based on cost or market value?
Proportion of what? Of the interest of every party? Can he speak? Can he speak up?
He didn't specify in the question. Maybe he can speak.
Can you specify the item that you are meaning by this? Because for proportionate we have different items, but usually here we don't talk about future values. We talk about results. We talk about, because this is again a Sharia requirement that you cannot distribute profits, you cannot incur expenses that didn't arise. So we cannot talk about only expectations unless we need to do certain preliminary accounting, and later on we reflect the actual results on the account on the books of accounts of every respective party. But
Brother, Dr. Munir said it is related to proportionate allocation of assets, paragraph 12 or 13.
Actually, it depends on the stage. If you're talking about initial recognition, we have to do that based on fair valuation. Fair valuation if the assets are provided in kind, at cost if the assets, or at their monetary values if the assets are provided in cash. So it depends on the type of assets that we are talking about and the stage of recognition. But again, we have AOFI applies different measures. All of these measures are in line with Sharia, I mean the measurement basis, and we have to comply with this measurement basis that you can come across in FAS 1, in the framework, and in respective standards, depending on the mode of investing, mode of finance, or the product itself, or the structure. So this may vary from transaction to transaction, from stage to stage, depending on the case. But all in all, we don't only refer to in our literature, we don't refer to market value. We use fair value, which is a derivation of market value, at a different level, but that is more in line with the Sharia requirements, because under Sharia, the best measure of value is considered to be fair value, and this has, doesn't contradict our accounting, requirements and measures also, because this is much closer to justice, as it's fairer, much closer to justice, and it reflects the rights and obligations of the various parties in a fair manner. So fair value as a measure is it comes as a core, at the core of financial reporting for certain, not all the transactional products, but for certain assets that their values are or has this kind of connection with the market. Any other questions?
No
Presentation
questions.
disclosure. Yeah, so we are going one by one through all the accounting elements or the stages, where we start with initial recognition, measurement, subsequent measurement, the presentation and disclosure of these items and amounts. So for every scenario, we have these full set of accounting tools. Presentation disclosure, all asset liabilities, revenues, expenses, gains, and losses, and their pass-through approach shall be presented, as we mentioned, on a gross basis rather than being presented on a net basis. And then these are to be clubbed on a line-by-line basis with the respective assets, liabilities, revenues, expenses, and gains and losses in the financial statements of the investor. These shall, however, be presented and disclosed in a manner that the same can be identified as relating to the participatory venture through additional disclosures, because for the investor, the investor may have different ventures, may be involved in different ventures, different transactions. So insofar as this can be useful, also reference or disclosure providing additional disclosures to this specific participatory venture is also recommended. The working partner's share of profit determined in line with requirements of paragraphs 15 to 17 shall be included in related expenses and disclosed appropriately, because here we have to be as much transparent on this kind of the profit share profit determination and distribution. So this is also come as like holds a center stage for Sharia, as you will always see that it is one of the key differences with international standards, that IOFI standard focuses on this particular processes that relate to distribution of rights, profits, and coverage of losses in line with the contractual setups and in line with the Sharia requirements. Any question before we move?
There is a question from Mr. Ruwais. I think there is no provision in the ED for termination during the contract.
I didn't get the question. What does he mean by that? Can you elaborate on that, please? No coverage of what?
No provision in the ED for termination. If you can.
Termination of the structure or the venture.
I think this is what he meant, during the contract.
Yes, we will come into that. We'll come into that, inshallah. Any other question?
No more questions.
Yeah, actually, for different scenarios, even under the old standards, we have the exit strategy. Exit strategy is well covered, and it is there where the rights and obligations of different parties are. If I decided to terminate early, This will be subject to different set of requirements. We will come into that. And if the items or if the investments that I have are still in physical form or in partially in monetary form or whatever form, this will determine the way I distribute the respective shares of each and every partner and counterparty into the transactions in a fair manner and in line with the Sharia principles and rules. But this is overall, this is the concept of constructive liquidation, in which case it may apply in here, though it is actual, I know, but constructive liquidation calls for calculation of the outcomes of the ventures prematurely before the end of the investment period or the maturity of the investment or maturity of the venture. So in a sense, this is this is subject to this kind of premature arrangements that gives an exit strategy or exit way for the contracting parties if they decide, because once they start, mudaraba, musharaka are binding, but it's up to both parties to agree on an exit, and this is covered in particularly under Sharia, the case of Sharia. Here is that we have certain ahkam or provisions for that that will also be reflected on the accounting treatment. But we'll come into that. In addition to the normal presentation and disclosure requirements applicable as per respective FAS, the minimum disclosure requirements shall be as follows: summary of contractual relationships and significant terms and conditions, ownership structure of the venture, the proportion of participative venture owned by the investors in the event of having more than one investors. This is again all common sense disclosures. The nature of underlying assets and activities managed under the participative venture, and any contingent variable profit payable not recognized as a liability. It has to be also disclosed properly. Accounting by the investor under net investment in participative venture accounting approach on initial recognition. While applying the net investment participative venture accounting approach, an investor shall initially recognize the investment made as an investment in a participative venture at cost. This is one of the measures, as I mentioned, at the time when it is made available to the prospective working partner for investment. So here, this involves both accounting and Sharia. It is recognized at the time it is made available to the working partner, because in which situation the working partner would be empowered to initiate the investing process. Otherwise, in Sharia, if you are talking about just going into signing the contract, entering into the contract, and without enabling the partner to initiate the work, so again, this cannot be the transaction cannot be initially recognized and cannot be established as an item in the financial statements. In case of investment in kind or in-kind investments, the initial recognition shall be based on the fair value of the in-kind investment as at the date of investment. In case the investor has made investment available to the prospective working partner or partners, but the contract is yet to be initiated, such amounts shall be initially recognized as an advance against investment in the participatory venture till the time such contract is initiated. So these are the different, scenarios where the contracting parties may have at times they pay or earmark the amount, put it in account, but the work is not initiated. So this also in itself entails certain Sharia requirements, and this is in turn this impacts accounting treatment at different stages. Subsequent measurement, the investment in the PV shall be measured at the end of financial reporting period at carrying amount. We mean by that the amount adjusted for additional capital contribution, if any, capital withdrawals, if any, and payment of distributable profits, if there are profits, and shall be adjusted to include the net share of the profit or loss of the participative venture as attributable to the investor under the contractual arrangements as determined under the relevant FAS as at that date. So connection with the date is very important from both accounting and Sharia perspective, because at that date rights and obligations can be monetarily established, and this is can be fair to all the parties and can properly account for the Sharia requirements in this aspect. Net share of the profits and losses duly comprising the net result of the revenues, expenses, gains, or losses arising from investment in participative venture shall be determined after allocation of the working partner's share of profit, including variable profit. This is again in line with Sharia. So we don't, go into recognition of any net shares before we do the allocation of the share of profit of the working partner. Any questions so far?
No question.
No question. Okay. Any share of losses reimbursable by the working partner as established in line with Sharia principles rule due to the working partner's negligence and misconduct shall be recognized as a reduction in losses or as a profit where applicable when determined as such. So this is again one of the scenarios where there might be some certain foul play on part of any of the partners. So Sharia also in the Sharia standards, the issue of negligence or misconduct is properly covered, and this is also reflected here on the accounting treatment. So recognition shall be as a reduction in losses or as profit where applicable, but only when such negligence and misconduct is properly determined following the Sharia mechanisms in that regard. The investor shall determine at each period end impairment of the value of the investment in a participative venture in line with the requirements of FAS 30. In this case, the settlement risk, as we mentioned, as well as existence of onerous commitments such as guarantee or sale undertakings shall also be considered for impairment purposes. At this impairment will also, initially will impact the monetary amounts that under which these items are reflected in the financial statements, and in which case this will impact these amounts and the rights and obligations of different parties. Presentation disclosure, we continue share of profits and or losses arising from investment in participative venture shall be disclosed separately from other revenues of the investor on a net basis. In addition, the investor shall disclose the following as minimum disclosure requirements: summary of the principal terms and conditions of the arrangements between the parties, the nature of the underlying assets and or activities managed. This is again saying here, any contingent profit payable to the working partner not yet recognized. This is, as you can see, this is like uniform disclosures that come up again and again. In respect of any investment in participative venture, which is considered material to the financial statements of the investor shall preferably provide memorandum information in respect of assets, liabilities, revenues, expenses, gains, and losses, as well as the profits or losses attributable to the working partners. Just to give more details about these material transactions, material accounts, given again the principle of materiality in accounting, and given also that this practice is much closer into fairer treatment and entailing the respective Sharia permissibilities and impermissibilities. Accounting and financial reporting in the books of account of the working partner. We are done now with the investor. Now we are moving into the working partner. Also, for the working partners, we have different scenarios. Any questions so far?
No questions.
Okay. We follow the same sequence of processes. The working partner shall apply any of the following approaches for accounting and financial reporting of its interest in a participatory venture. These were summed up in the table. In case the venture is controlled by the investors only on the other side, so off-balance sheet accounting approach as prescribed in paragraphs 32 to 37 shall be applied by the working partner. In case the participating venture is controlled by the working partner himself or herself only, then quasi-equity accounting approach shall be applied as prescribed in paragraphs 38 to 47. So for every scenario, as you can see, there is accounting logic for that, and the need to also account for certain financial reporting requirements for every situation. In case the participating venture is under shared control of the investors and the working partner, the net investment in participatory venture accounting approach shall be followed, similar to that of the investor, that as we have seen earlier. And here we have to consider that the working partner's capacity of investor is his primary capacity as prescribed in the paragraphs 21 to 30 that we have covered. Accounting by the working partner, again, under the off-balance sheet accounting approach. Under this approach, the working partner shall not recognize the assets or liabilities underlying the participating venture controlled by the investors in its books of accounts. If the working partner previously owned such assets and liabilities through equity or quasi-equity, the working partner shall recognize the assets first and any corresponding liabilities from its books of account, and any gain or loss on such disposal shall also be recognized immediately. This falls immediately, being the difference between the carrying value of such assets and liabilities and the value agreed upon contractually. Then, under the same approach of balance sheet, net with respect to the investor's share of profits on the other side. So now we are talking about the counterparty. Now we are when we need to do the accounting for this transaction, we have also to consider the net share of the investor on the other side. So net share of the profits duly comprising the net result of revenues, expenses, gains, and losses arising from investment in the participating venture after allocation of the investors share profit and losses where applicable shall be recognized periodically. Any share of losses reimbursable for different reasons as established in line with Sharia principles and rules due to the working partner's negligence and misconduct shall be recognized as an expense when determined as such. Again, this is the same treatment here. Contingent or conditional share of profit receivable by the working partner as per contractual terms shall be recognized when there remains no material uncertainty with regards to its recoverability, duly applying the following principles. The variable share of profit related to past performance based on contractual arrangement shall be recognized as and when it becomes receivable. Again, this is a Sharia requirement. And the issue of material uncertainty and its impact on recoverability is here very important. And this in itself, it also impacts our recognition process. Accounting by the working partner under the same approach of balance sheet, investor share of profit, a variable share of profit related to past performance, which is contingently reversible on a cumulative basis, for example, a reversal in case of a future loss, or is contingently dependent on decision by a third party, the decision of trustee, for example, at maturity of the transaction, shall not be recognized except to the extent of the best estimate of amounts recoverable with reasonable certainty based on justifiable future projections and established customary practice. After allowing for reasonable margin for uncertainties, and then the variable share of profit related to or fully dependent on future performance shall not be currently recognized irrespective of their probability of recoverability. Here, because we are talking about the current period, so we exclude that of current recognition. Because this doesn't impact the current period. Presentation and disclosure in case of applying of balance sheet accounting approach, working partner shall at a minimum, the same now we come into presentation and disclosure. Summary of the assets. The minimum requirements include summary of the assets, liabilities, and related movement, including income on such assets and expenses thereon collectively for all of balance sheet participative venture. This shall be disclosed appropriately in the financial statements, either in the form of a statement of off-balance sheet assets under management, or where applicable, or in the notes to financial statements. The standard is flexible on that, depending on the partner or counterparty needs. The total administrative and operational expenses charged to the participatory venture, along with a brief description of its major components based on materiality of the amount. Also, the amounts of profits and losses attributable to the investors and the working partner, respectively, identifying any variable incentive or tiered profits, and the basis applied by the working partner for determining variable share of profits from the venture if such profits are material. Any questions so far?
No questions.
No question. Okay, the cumulative amount of contingent share of profits receivable but not recognized due to conditions provided earlier, as I mentioned, disclosure of transfers of assets from or to owned assets or to from the participative venture shall be adequately made in line with the requirements of respective FAS. So here we are talking about transfer of assets. So in this situation, we refer to the standards on transfers of assets. Accounting now by the working partner under the quasi-equity accounting approach. On initial recognition, under this approach, a working partner shall recognize the amount of quasi-equity of a participative venture in its books of account. That would be equal to the amount of cash received. Here there is a typo, or the word off, in the event of investment in cash. So if we have the investment in cash, it must be the amount of cash received. B, the fair value of the underlying assets, net of liabilities, if any, as at the date of investment in the event of investment in kind. So as I mentioned earlier, depending on the item itself, we have to apply different measures. Every measure justifies its used because of the different nature of the assets that is being measured. Continued initial recognition. At the time of initial recognition of quasi-equity of the participative venture, in line with the requirements of paragraph 38, previous paragraph, the underlying assets and liabilities, if any, shall be recognized in the books of account of the working partner at the current carrying value of such underlying assets liabilities already owned by the partner, as appearing in the books of accounts of the partner in case the investment is received in cash, and the value assigned to the underlying assets and liabilities that is in this case equal to their carrying value, or at the contractually agreed value of such underlying asset liabilities already owned by the working partner in case the investment is received in cash and the value assigned to the underlying assets is different from their carrying value. And at the contractually agreed value of the underlying assets and liabilities previously owned by an investor as at the end of investment in the event of investment in kind. This covers the different cases, as I mentioned. In case of application of paragraph 39B, any difference between the contractually agreed value and carrying value of the underlying assets, net of liabilities, shall be accounted for as follows. Any gain or loss not being an investment loss shall be amortized by the working partner over the period of participatory venture. Why? Because here, as we are saying, it is not related to the investment process. So in which case, deferment and amortization is called for spreading out the impact of such irregular, unusual items across the different periods to better, reflect the performance of the venture at or during the extended period, not just only in part of the period. Unless the participative venture does not have a fixed period of maturity, or if it is not committed or reasonably expected that the working partner will acquire full ownership of the underlying assets of the venture, either through gradual transfer or at the end of the term, in which case such gain or loss will be shall be immediately recognized by the working partner. So we have to differentiate here between two cases as the standard identified, because for every case there is a treatment, and there is behind that there is the justifiable الحكم الشرعي, in addition to the practicability of the practice that we are following in this particular area. Also here, any loss being an impairment loss shall be immediately recognized by the working partner, given the nature of the loss. Or here it is related to impairment, so it is the treatment is that we recognize it immediately. Subsequent measurement now, next stage. Subsequent to the initial recognition, working partner shall follow its normal accounting policies established in accordance with the relevant phases with regard to accounting for the underlying assets and liabilities and recognition of relevant items, revenues, expenses, gains and losses, including any impairment related to these assets, if any, which relate collectively to the participatory venture. The investor's share in profit or loss payable shall be also recognized at the end of each financial reporting period as an expense. This is a common practice. You will come across that time to time in the same standard. Any share of loss is reimbursable also as established in line with Sharia principles and rules due to negligence or misconduct by the working partner shall be recognized as an expense. Again, this is a common practice. A provision shall be maintained for any contingent or conditional share of profit attributable to the working partner as per contractual terms in respect of any variable share of profit related to past performance, which is contingently reversible on a cumulative basis, as we mentioned earlier, reversible in the case of future loss, or contingently dependent on a decision by a third party, such as a trustee, or at the maturity of the transaction. And out of this provision that has been made, any amount may be taken to the income if and only if, and to the extent that there remains no material uncertainty based on the justifiable future projections and established customary practice. So the purpose of this provision is to make this uncertainty as much as immaterial, in which case this impacts accounting and impacts recognition and subsequent measurements of these amounts in the books of accounts of the working partner. Presentation disclosures. In case of applying the quasi-equity, the working partner shall, at a minimum, provide the following disclosures: summary of the underlying asset, liabilities, and related movement, as we mentioned earlier, including expenses thereon collectively for all participatory ventures to be disclosed appropriately in the notes. Duly identifying the amounts attributable to quasi-equity. This is very important. We have to identify the amounts that come from quasi-equity and commingled equity respectively, because for every tier we have its a different set of requirements. The total administrative and operational expenses, as well as impairment losses on the assets of the venture, if in existence, shall be charged to the participative venture, along with a brief description of its major components. Here, once charged, we have also to provide these kind of disclosures mainly the major components of these items. And then the amounts of profits, losses attributable to investors and the working partner, respectively, identifying any variable, incentive, or tiered profit, as well as the amounts of profits attributable to the working partner on account of commingled equity. The basis applied by the working partner for determining variable share of profits, which it receives from the profits of the participatory venture, and the cumulative amount of and movement in the provision that we have created against the contingent share of profits or consideration due to the conditions that we mentioned in the previous paragraph. Disclosure of transfers of assets from and to owned assets or to from participating venture shall be adequately made in line with requirements of respective FAS, because of the different nature of these two types of assets, and following the requirements of the respective accounting standard FAS on transfers of assets. In addition to the respective specific requirement of this standard, the requirements of respective FAS also applicable to quasi-equity shall be applied by the working partner insofar as practicable. This is again the issue of practicability, as I mentioned earlier. Specific considerations for perpetual. We have come now to the specific cases that may come under the banner of participatory ventures. Those are these cases we may come face to face with in practical life and reality, where different modes of transactions are carried out by different financial institutions in different jurisdictions. So these practices are also covered insofar as these practices are in line with Sharia. Certain participative ventures, though in relation to circumstances, may be perpetual in nature, that in the sense that they are not subject to liquidation at the fixed maturity date, or these do not have a put option of redemption in the hands of the investor. So the investor does not have the right to go and put it back to the other parties. This is in terms of the concept of perpetual participative venture. There is a rebuttable presumption that such participatory ventures may qualify for accounting as equity under requirements of relevant FASs and presented as separate class within equity, given the specific nature of these ventures. Because for equity, you don't have, for example, the put option. Here, if you have the put option and still it is a kind of a stake or interest in equity, so you have to classify it separately within equity, but it has to be subject to its own reporting. In such case, the working partner shall follow the accounting requirements applicable to the underlying assets and liabilities, etc., under the quasi-equity accounting approach, as prescribed in paragraphs 38 to 46, if practicable, while following other requirements of the respective or relevant FAS. The investor shall follow the net investment in participative venture accounting approach as prescribed in the paragraphs that we have covered, 21 to 30. Forms of transfer of control, because as we mentioned earlier, the transfer of control also determines the relationship between the parties and which party is required to or has the right to control and to recognize, record the transaction in its books of accounts. The transfer of ownership and any corresponding control for investors to working partner in the case of most participating ventures takes place through transfer of control, which entails risk and rewards incidental to ownership of such underlying assets under a separate arrangement, taking the form of either the following: sale undertaking by the investor or purchase undertaking by the working partner, executable after the end of the venture term, or at times when this is again one of the exit strategies, when this is partial exit or gradual exit, when a specific event triggers early liquidation, or participatory of the participatory venture, a gradual sale of proportionate ownership, generally in the form of ownership units, through a promised mechanism over the term of the participatory venture. So it might be through an undertaking, or it might be through gradual sale of the proportionate ownership of each and every respective partner or in the structure. And then partial redemption of the investor's equity through partial sale of proportionate ownership, generally in the form of ownership units based on mutual agreement if the agreement is there before intended maturity of the venture. A transfer of control from investor to working partner continued. A timing of the transfer. Transfer of control shall be accounted for by both parties at the time of transfer of control of the underlying asset or proportion of that to the working partner. The timing of transfer of corresponding control of the asset or proportion of the assets to the working partner shall coincide with the timing of consummation of the relevant contract, either through documentation of offer and acceptance of the transfer of ownership or proportionate ownership of the underlying assets, or payment against purchase of such units as a continuing arrangement and acceptance of such payment if already documented through. So documentation here is very important for those transactions that be repetitive in nature, if already documented through a purchase and taking in line with Sharia principles and rules and contractual arrangements. Recognition of transfer, complete or partial, under all forms of intended or mutually agreed transfer of control or proportion thereof from the investors to working partner. The transaction of transfer of control of underlying assets and liabilities or proportion shall be recorded separately from the transaction of investment in participating venture and recognizing returns thereon in line with requirements of paragraph 50. The investor or investors, irrespective of the accounting approach followed, shall recognize. This is, again, accounting logic, shall recognize, because this is the how the transaction ends up once this transfer is carried out. Shall recognize the underlying assets and liabilities or proportion, the respective proportion, from their books of account, while recognizing a gain or loss on such a transfer being a difference between the carrying value and the fair value of the consideration received at the time of, or receivable if not actually received at the time of the transfer. Any questions so far?
No questions.
No questions. Okay. The working partner at the time of partial acquisition of control shall apply the respective accounting treatment from the following corresponding to the accounting approach being applied. In case of applying the quasi-equity approach, it shall record a reduction from the amount of quasi-equity reflected in its financial statements attributable to the investors, while recognizing gain or loss. Again, same scenario, same process here, on such transfer being the difference between carrying value and the quasi-equity and the fair value of the consideration paid or payable, because in this case it is just the opposite, where the other party has to pay, and these amounts might be actually paid or might be payable depending on the situation. In case of applying the net investment participating venture approach, shall increase the amount reflected as net investment in respective participating venture at cost of such additionally acquired units for the party that acquires these units. There is a rebuttable presumption that a working partner applying the off-balance sheet accounting approach may not experience partial transfer of control from the investor except for extraordinary circumstances. In such an event, the working partner shall reassess the suitability of accounting approach and shall preferably change the same to either of the following as considered appropriate: either quasi-equity accounting approach, which may become more suitable when it is considered that the working partner controls the venture, or net investment in participating venture accounting approach, which may become more suitable when it is considered that shared control exists. So again and again, you can see that the element of control determines the different scenarios and determine the flow of resources and how we can, treat these kind of transfers between the parties. The working partners at time of complete acquisition control shall apply the respective accounting treatment for the following that correspond to accounting approach being applied. In case of applying off balance sheet initially, the working partner shall recognize all underlying assets, liabilities of the venture in its book of accounts, while recognizing any gain or losses on such transactions measured as the difference between the fair value of the assets and liabilities recognized in its book of account and as a result of such transfer of control, and the consideration paid or payable in respect of transfer of complete control of Participatory Venture. Again, the same process. In case of applying the quasi-equity approach, accounting approach, the partner shall de-recognize the amount of quasi-equity reflected in its financial statements attributable to the investors, while recognizing any gain or loss on such recognition. The loss or gain is the difference between the carrying value of the quasi-equity or that portion of quasi-equity and the consideration paid or payable. Or again, in case of applying the net investment in Participatory Venture approach, shall recognize net investment in Participatory Venture and recognize all the underlying asset liabilities of the Participatory Venture in its books of account, while recognizing a gain or loss, if any, on such transactions as a difference between fair value of the underlying assets and liabilities, as we mentioned, and the carrying value of net investment in Participatory Ventures, plus here the consideration paid or payable in respect of transfer of complete control of the venture. Any questions so far?
No questions.
As you can see, all the scenarios have something in common that in case of the transfer, the unit or the respective share of proportionate share of that ownership transferred has to be accounted for at two different levels: the unit itself and any profits or losses recognized as part of the process. So this has certain commonalities between the different scenarios. Onerous commitments for redemption, gradual transfer, a commitment to transfer ownership or proportion of the ownership from investor to working partner at the promised value or at fair value, which at times may be different from carrying value of the net assets of the venture, may turn onerous in certain situations on either party if it results in an expected loss on such redemption or gradual transfer of ownership, in which case such onerous commitment may exist in the form of purchase undertaking by the working partner or a sale undertaking by the investor or gradual transfer arrangement between the parties. So these arrangements result in this scenario of onerous commitment, and investors or working partner being subject to this onerous commitment shall record a provision against such onerous commitment in line with the requirements of FAS 30. Gradual transfer of ownership, there is a rebuttable presumption that Participatory Venture with gradual transfer of ownership in case of diminishing musharaka here with Shirkat Al-Aqd may not be eligible for any accounting approach except for, in case of investor, the net investment in Participatory Venture accounting approach, and in case of working partner, the quasi-equity approach. So otherwise, it may not be eligible. So here we are, because it's gradual transfer. So to start with, we say the presumption entails that it may not be eligible except under these two scenarios, because of the specific situation of gradual transfer. In case of a variable participatory venture, variable equity, only the following accounting approach shall be applied. In case of investor, the net investment in participatory venture, because this again accounting logic, we cannot, if it's a variable equity, you need to reflect that in the net investment in participatory venture. And in case of working partner, the quasi-equity, because on the other side you have to apply the quasi-equity accounting approach. Any drawdowns and redemptions of the quasi-equity of the investor under a variable equity participative venture takes place at cost in line with the relevant rules and principles and contractual arrangements, and hence are accounted for at cost equal to the amount of cash received or redeemed, invested or redeemed without recognition of a gain against the carrying value. Any questions so far? I just want to remind our valued participants and colleagues that whatever you may come across in terms of drafting of the standard or any conceptual issues or any treatments that you feel there might be a better, a better approach or better treatment or better methodology that is both in line with Sharia and in line with AYUFI framework, please come up and either now you can share your views or you can send us your comments in writing, and inshallah we will make sure that we take that into consideration through the respective working group. Under the same title, variable equity participative venture, attribution of profit or loss to the respective parties shall be made at the end of financial reporting period according to the weighted average balances as remained outstanding during the period and the profit sharing ratios as contractually agreed in line with Sharia principles. And in addition to the specific requirements of this standard, the requirements of respective FAS applicable to quasi-equity shall be also applied by the working partners as much as practicable. Risk reserves, accounting for risk reserves, if any, shall take place in line with the contractual requirements, considering the requirements of respective FAS on risk reserves. Adequate disclosure shall be made in respect of balances and of movements in respect of risk reserves in line with the disclosure requirements, contained in the reserve standard. Accounting and financial reporting by the participative venture. Now we covered both sides of the transactions are separate sides, the investors and the working partners. Now we look at the participative venture at large. If the venture is in control of this, the venture itself is in control of the underlying assets, not either party. So in this situation, the objective of accounting and financial reporting for participative venture is determined as follows: is to provide timely and faithful information about financial position and results of operation. This is very important. We have to bear this in mind that here the objective is different, to provide timely and faithful information about the financial position and results of the operation. So now we are talking about the operation at large of the venture to both the working partner and the investors in order to enable them to incorporate such information in their respective financial statements on a periodic basis in line with the requirements of this standard and any contractual agreed conditions. Or also as required by regulations in certain countries. Summarized financial information of the participative venture as a virtual entity shall be prepared, this is very important, in line with the requirements of this standard on a periodic basis, commensurate with the financial reporting requirements of the working partner and as well as the investors. Summarized financial information, set of summarized financial information of participative venture shall comprise the summarized form of the following: summarized report of financial position, as I mentioned, this is very important. Summarized report of income and expenses, again important, and explanatory material to the financial informations if needed. We need to provide this, complementary financial information on certain aspects of the operation. Selection adoption of accounting policies for the venture. Now we are talking again, I'm just emphasizing on the venture because here we're talking about financial position of the venture, income statement of the venture, any material information of the venture. So for when we are selecting policies, financial reporting and characteristics of summarized financial information of a participative venture shall be commensurate with the nature of the business carried out by the working partner, particularly those relevant to the participative venture itself, where we are talking about the working partner, because the working partner plays an active role in managing the business or the operation. The accounting policies selected and adopted by for the purpose of financial reporting by the venture shall generally be aligned with the accounting policies adopted and applied by the working partner, again for the same purpose, insofar as this is in line with the requirements of relevant FAS. Accounting policies applied to the purpose of financial reporting of the participative venture may be different from those applied by the working partner. If either of the following conditions is met, such accounting policies better reflect the financial information in light of the contractual requirements between the parties and the business model of the participative venture. So here, different level, the level of the venture, which entail that better financial information are provided because of the specific nature of and the specific requirements that the venture itself is subject to, particularly the business model of the venture. And the accounting policies generally applied by the working partner are not in line with requirements of relevant. What if the working partner itself is not complying with relevant FASs or their application for the purpose of financial reporting? This may also result in a non-compliance with Sharia principles and rules. Determination of accounting policies and application of significant judgments and estimates, like depreciation, amortization for the venture, shall take into consideration both the business model, again, we're talking about the venture, and the term to maturity of the participative venture, considering that the business model and the expected maturity of the venture, it's expected that the accounting policy selected shall take a simplified form and complex accounting treatments at times, and involvement of additional financial statements. Here, there might be a need to publish or to prepare additional financial statements, like statement of other comprehensive income. In this situation shall not be necessary under this standard for the reasons identified in this paragraph. General accounting considerations. Now, what about the general accounting considerations for the venture itself? Accounting, including initial recognition and subsequent measurement of assets, liabilities, quasi-equity, equity, where applicable, and recognition of revenues, expenses, gains, or losses, shall be performed by the participative venture in line with the accounting policies selected and consistently applied, and the significant judgment and estimates applied by the management of the venture. Any gains or losses as applicable to the investor and working partner prior to or at the time of commencement of the venture shall not be considered as an income, expense, or gain or loss of the participative venture, because for the same reasons that the venture has not commenced in earnest, and this is both a Sharia requirement and accounting practice. Any redemption of quasi-equity as well as drawdowns of additional quasi-equity that results in transfer of assets to or from the venture to either party shall be accounted for at carrying value. Any additions? Here we come into presentation disclosures. In addition to the relevant significant presentation disclosure requirements stated in respective FAS, the following are the minimum disclosure requirements. Disclosure of the nature of the venture, its underlying assets and main activities, including products, the underlying contract and the salient features of contractual requirements applicable to the investment and any changes thereto, as well as the governance structure of the participative venture as may be applicable. And information about any ring fencing or other form of segregation of assets from other assets of the working partner as applicable, and disclosure of fair valuation of the venture and the significant underlying assets, as well as any potential impairment or credit losses, along with necessary disclosures of valuation or techniques used to determine the fair value, along with the level of observable inputs used. Note, fair value shall be determined with suitable frequency, ensuring that the decision-making of the investors might not be affected by the obsolescence of information, and information about the tangibility of underlying assets where applicable in line with the Sharia principles and rules, because the decision or the issue of tangibility affects many aspects in the works of the venture, particularly in certain situations where transfers of assets from or to partners may be also involved. At the time of liquidation of participative venture, the details of transaction execution and its financial effects on the respective parties. This is very important. This is as part of the exit strategy that we mentioned, and balances of and movements in risk reserves if these risk reserves have been actually created. Disclosure of any charity and its movement, including any income taken to charity, if any, and the way it is disposed. Disclosures about zakat related to participative venture in line with the requirements of the AYUFI standard on zakat. And with that, we have reached the end of the standard. For every standard, we have the board discusses and agrees to set an effective date. That date takes into consideration multiple aspects of application. It gives at times more room for institutions to readjust their reporting and to start moving into the new standard under the new regime. So this effective date is usually set like 1 or 2 years from the date of issuance, depending on complexity of the standard and the specific requirements for certain institutions, such as, for example, in the case of takaful, where the takaful system may need to be like properly readjusted. With these in certain situations takes more time. So an extended period for mandatory applications is offered. But still, in all situations, early adoption is encouraged for this standard beginning on or after the 1st of January 2026, if inshallah it is issued this year. Transitional provisions, and for certain standards, we add transitional provisions. An institution may opt to apply this standard on a prospective basis for transactions executed or on or after the effective date. If an institution applies this transitional provision, it shall disclose the impact. So the purpose here is that the institution, if it is given this, leverage for application, for adoption, they can also apply and do that at their own level. But the standard calls for disclosure of the impact of this transition or migration from over time. The impact of that is of a material importance, and it has to be disclosed properly. Amendments to other standards, as we mentioned at the beginning, it supersedes FAST 3, Mudaraba financing, and FAST 4, Musharaka financing. Once it's issued, it will supersede both standards. Alhamdulillah Rabbil Alameen, and thank you very much. If you have any questions, please proceed and come into the floor. People can either, talk, address the audience live, or drop their comments.
Brother, there is a question from Mr. Sayyid Imtiaz Abbas. He's saying there may be an appendix showing illustrations to comprehend them more clearly. But
illustrative financial statements, he means actually this takes place at different levels for different standards. We will consider the practicality of that, inshallah. Yeah, actually, for certain standards, we issued illustratives. For FAST 1, also we issued illustratives. Though these illustratives are not don't have the nature of a standard. They are just complementary. Not mandatory in nature, but can provide clear examples, clear format about the way financial statements are presented. That might be important. We are noting down your suggestion, and you may need to I may need to refer you to Fast One illustratives. You can also have a look at this. For certain standards, we are issuing illustratives, set of illustratives like for WAQF, like the WAQF and interim reporting, Zakah. So depending on the evaluation of the board and the practical need for issuance of such illustratives, yes, inshallah, we can consider that. And this can also come as part of the broader, efforts that are being expensed at the level of AYUFI and the board to come up with guidelines for implementation, inshallah. But this is a daunting task to say the least, and it may take more time, inshallah. And we can hope that it can be done as soon as possible, but it would take a lot of efforts and resources into that. But inshallah, we hope that with the help of the industry and the help of the experts and all the stakeholders, that inshallah we can deliver on that shortly. Any other questions?
So far, there are no more questions.
I think we are within the assigned time. We managed to complete the standard in 2 hours. Okay. I would like to thank all our valued participants and colleagues, experts for being part of this session. Again, I'll be back to you, Hawra, for concluding remarks. Thank you very much.
Thank you very much, Brother Majd, for the insightful presentation and the Q&A session. We would like to thank the Bahrain Association of Banks and UAE Banks Federation, all the participants, and all our colleagues here in AYUFI. Inshallah, we see you again in the future in other public hearings and other standards in both English and Arabic. Wassalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum assalam. Bi aman Allah.